Hi there, and you have just tuned in to Dukascopy TV today. Well, we're going to have a look at banking regulation and of course Basel III, which is a very hot topic at the moment. The Basel Committee on Banking Supervision recently announced downward revisions to liquidity coverage ratio. On this topic today, I have Nicolas Perdu from Antaes Consulting. Welcome today.
Hello, thank you for having me.
So, Nicolas, in terms of latest developments with banking regulations and of course Basel III, what has been going on and of course what are your greatest concerns, and do you think dilution of Basel III could actually threaten global security?
Well, indeed, dilution was a major concern with regards to this latest decision from the Basel Committee. What we're talking about here is dilution of the liquidity coverage ratio, which is a key item of the Basel III package, I would say. Just remember that it is aiming at preventing any liquidity crisis within 30 days for banks, so it's crucial and key for banks. It has been changed. Some of the commentators would say it has been diluted. I'm more saying that it was changed and maybe better thought than before. If we look at it, maybe let's look at the spirit and then the details. Spirit of it, of the change, was to keep on allowing banks to lend money, basically, their major business. So not preventing any recovery from the economy due to a harsh liquidity ratio. Then if we look at details, indeed, it looks a little less harsh than before. You can have more assets that are eligible for your liquidity. For instance, on the asset side, you can have corporate bonds down to BBB-, I believe, which is a change from before. But those new assets you can use, they are first they are subject to a haircut, a strong haircut, and then they are capped within your liquidity pool. Same thing for retail mortgage-backed securities. So in this, we are seeing some minor changes. But key decision for me is to make this ratio applicable and to gain some buy-in from the banks, from the local regulators, because we need to keep in mind that Basel III is proposing regulations, but then the local regulator, they will need to implement it. So implementation is really key, and if we want to have a sound ratio implemented and used locally for banks all over the world, in Europe and in the US mainly, we need to have something with some buy-in. I would say also that the planning is kept. Indeed, banks will not have to comply to the full ratio with the full ratio from 2015, only to comply with 60% of it. But still, it means that from 2015, they will be using the ratio, they will be calculating it, which is not that easy, and ideally they will be communicating already this ratio. So to me, not really a dilution, more a change due to the economic reality that we face today.
And Thomas Hoyne, the Republica board member, now he believes these rules are set in place in order to strengthen banks and help them tackle off all the threats they faced, like in 2008. Now recently in a speech in November, he said we should learn from past experience and turn our attention from using a capital rule that gives what in the end is a false sense of security to one that is effective because of its simplicity, clarity and enforceability. Now, Nicolas, what are you thinking in regards to this?
Well, obviously, learning from the past is key, and it should lead any new regulations. This is true for the liquidity coverage ratio we discussed. We cannot forget the hard time we went through some years ago, and obviously the point of the Basel Committee is not to forget about that. But then, learning from the past is key, and indeed implementation of the regulation is key as well. So I guess having very clear rule, simple and enforceable, is key to make sure that this ratio will be calculated, used, communicated So what I kind of understand from this quotation is that we need to learn from the past. This is a valid point, and for sure we need to do that. But at the same time, we need to think about the future of what we're trying to implement. Hopefully, what we are trying to implement worldwide. So we need to take everything into account and to have something very clear, very enforceable for the future.
Thanks, Nicolas. And just in terms of finishing off this, if we look into the future, what do you see in terms of banking regulations and, of course, Basel III? And what type of impact will this have for big banks, major Swiss players, and, of course, local banks as well?
Well, looking at the overall Basel III regulation, I don't foresee a lot of changes from what was announced. Obviously, the too big to fail rules will keep on applying to the major Swiss banks, and capital adequacy rules will be enforced in the coming years. In terms of the local actors, maybe we can talk about private banks, which is one of the main sectors here. Those banks are not that impacted by the regulation, by the liquidity and capital regulation, because they are not burning a lot of capital, and actually they are more of a source of liquidity, because basically they are taking a lot of assets from their clients. So in terms of impacts for the major Swiss players, I would say I'm not expecting a lot of impacts due to the recent change, and I'm not expecting neither a lot of changes for private banks due to this. They will keep on being a source of liquidity for their either for their bank or for their head office in case of subsidiary of bigger banks. Maybe the only impact for them will be kind of positive. They will be, I guess, due to the new ratio and to the new pool of liquid assets available. They can receive more incentives from their headquarters, head office, because of them providing even more liquidity than before.
Well, Nicolas, before I let you go today, I have one big question for you. Now, if you had 1 million, where would you invest it? Would it be bonds, gold, cash, oil, real estate, equities? Where would it be?
Well, we just mentioned recovery, and we expect that the banks will participate to the recovery in 2013, especially due to changes in regulation. So I would choose and I would pick equities.
And in terms of diversifying, what else would you choose?
The regulation was looking at a broader pool of liquid assets for the coverage ratio. So I would go for something similar, something well diversified. We mentioned corporate bonds, equity, a bit of retail mortgage-backed securities with a lot of precaution, obviously, but a pool of diversified assets, a bit bullish for this year, could be a good pick.
Thank you, Nicolas.
Thank you.
Well, viewers, as always, thanks for watching Dukascopy TV. Now, if you enjoyed this interview, then do tune back to the website for many, many more like it. But for now, goodbye.